Hey everybody, welcome to this free edition of our Trader User Group, a weekly roundup. This is for the trading week ending June 26, 2020. Half full, half empty, half full. Which is it? Well, let's go take a look at it. Before we do that, let's just take a look at the trading week and how things kind of came out. So what I want to do is just go take a look at the indexes and the index performance. If we look at the U.S. performance, as you can see, just about everything is in the red. The only green on the screen right now is year-to-date performance by NASDAQ. Otherwise, everything was in the red, not only year-to-date, but also this past week. The worst performer for the week was the Dow, down 3.31%. The best performer was NASDAQ, but it was still down, although it's managing to hold up its gains better than most. Okay. If we take a look at and peel it back a little bit more and look at the sector performance, the best sector was still down. It was technology, but it was down 1.45%. Energy was down a whopping 6.7% roughly. So it's kind of a bad performance. Let's kind of go around. Let's increase the aperture and go look at the world indexes and just kind of see here. You can see across Europe, everything was in the red. Worst performer was the FTSE over in London, followed by the DAX, and then the CAC 40, which is the Paris index over in France. Everything was in the red. Of course, over the Asia Pacific area, everything was relatively flat to slightly in the green. The Nikkei and the Shanghai NZEC was slightly above the break-even line, and the Hang Seng, the Hong Kong index, was slightly lower at 38 basis points into the red. And then, of course, if we go take a look at valuations for the markets, you can see here the PE ratio is the trailing 12 month is 27.21. The forward 12 month PE ratio is at 24.99, so let's call it 25. It's lower by about 8.16%, still elevated, but the primary reason is because the 10-year Treasury yield, as you can see, finished out the week at a little bit more than 63 basis points. The dividend yield in the S&P also managed to climb back up over 2%, 2.01% to be exact. So you can see the spread between the two is 1.37%. Folks, that's why a lot of money continues to flow into the equity markets in search of yield, because you can just hold in a basket of stocks, especially dividend stocks that have good balance sheets that aren't apt to cut their dividends. They're going to pay much better than the 10-year Treasury. Okay, besides the Treasury, the central bank in the U.S., as well as other countries, are gobbling up a lot of the selling volume of the U.S. Treasury. Let's go take a look now at the markets, and on these weekly sound bites here, as I mean, just put it up on the screen here. On the weekly sound bites, the market's kind of taken a punch to the gut this past week. I mean, the current reopening progress of a lot of the companies across the U.S. are kind of taking a hit with this rapid rise in COVID cases that we've been seeing here, all these newly reported cases around Texas, Florida, Georgia, some of the other states. It kind of throws a more clouded view of the U.S. political landscape as well. So there's reason for increased worry and volatility that we've seen this past week. But, according to one market adage, the bigger they drop, the larger the pop. As we've seen the markets bounce almost 40% off the March 23rd lows. Okay. But there's also an equally prolific market adage that says now that the easy money has been made, market pops can lead to market drops. So there we go. So we've got kind of a cloudy view going out over the summer months, with Q2 coming to a close here in a few days. This next week, it's going to be a holiday shortened week because Friday is a holiday for the United States, a big July the 4th Independence Day weekend. That will also prove to be interesting with all the riots going on. And then we move into the month of July, which I want to remind you traditionally has been one of the worst performing months coming up that we've seen. In fact, July statistically over the past 20 years has been an underperformer compared to all the other months for the year for the S&P, for the Dow for that matter. So again, amid all this market uncertainty, we've seen investors, though, continue to pour money into popular stocks like Amazon, Apple, Facebook, although Facebook took a hit and dive on advertising revenue concerns Friday. But that, Microsoft, Google, the market cap of those stocks are about 25, 27% of the entire S&P valuation. Really amazing. And there's like over 40% of the valuation of the NASDAQ 100 futures. Just truly amazing. So when these stocks stumble, the market index is going to feel it all over. All right. I mean, they're still going to outperform even in a down market, but they're all susceptible, I think, right now at this point in time to profit taking. And we also saw this past week the Feds, they ran a stress test of the nation's banks, and they found that the top 33 banks could suffer over 700 billion in loan losses in kind of a worst case scenario. So the Feds immediately ordered the banks to suspend their stock buybacks in Q3 and to cap their current dividends. So that kind of resulted in the financials to sell off on Friday. Okay, the stress test was Thursday. Most traders thought they would come out okay because they're much better going into this particular pandemic issue than they were going into the financial crisis in '08 and '09. But needless to say, the Feds capped their dividends and stock buybacks, so that kind of hurt the financials on Friday as we round out the trading week. All right. Now, as I said before, the market's half empty, half full. Okay, I mean, where are the markets and all this stuff? It's been about 100 days since the WHO, and I'm not talking about the band for all of you rock and roll fans out there. I'm talking about the World Health Organization. About 100 days since they declared the COVID-19 outbreak as a world pandemic officially. And the markets since then are up 40% off the March 23rd lows. So the next few months, the next, I don't know, 60 to 120 days, or we can just round it out and call it the next 100 days, I guess, is going to be crucial to how the year end is going to finish. And of course, we got the bullish camp on one side saying that you've got this massive stimulus, potential talk of more stimulus to come, infrastructure spending here in the U.S., global central banks just pouring money into each of their respective economies. So you've got a lot going for the bullish camp, but then on the bearish camp, we're seeing a slowing of the reopening of the countries here, or the companies here in this country, as well as starting to see in some other companies or countries, I guess. Getting those two mixed up, but we're seeing a slower reopening with this rise in COVID. Okay, we're also seeing a little bit of a higher valuation, as I pointed out earlier, as these cases rise. Key industry segments, I think, like travel and leisure and retail, is going to carry some of the biggest risk over the next 2 or 3 months as we go about seeing some profit taken off these lows on March 23rd. Okay, and then one final thing, and then we'll go out and take a look at the charts, is market valuations. I took a look at Sector Watch, and they use a different kind of evaluation metric, but it's very close. They take investment grade bonds. Take a look at that and compare it to the S&P Ford earnings per share estimates. And if you take those numbers and put them out in time, 12 months out, they're saying based on the current Ford projection of earnings for 2021, or the next 12 months rather, and you compare that to the investment grade corporate bond, which is yielding about 3.57% right now, that puts the market valuation a year from now about 35.63. So that shows we do have upside in the market, just depending on how this thing plays itself out. So there's a lot of ifs, ands, or buts. I haven't even begun to talk about the political landscape. I'll start bringing that up in about another 60 days when we get closer to the election. And just as a reminder, especially for those of you that are non-US based, don't pay attention to the polls. They're usually wrong, as they were not only here in the US, but on the Brexit for the Brexit yes/no vote. So I just think they're going to be an error this year as well. But it's going to be down to the wire. For our members, we're going to be up at 2 in the morning trading the markets like we did on the Trump Clinton election night results, as well as we were for the Brexit vote results. So I think there's going to be equal opportunities in this as well. So what I want to do is let me just freeze my screen here, or better yet, let me just move over to another chart. So let me just move this thing here like this, and let's get us over to another screen. And what I'm going to bring up, and what you're going to see, is a daily chart of the E-mini S&P 500 futures. And I'm using simple moving average on this rather than an exponential moving average. And I'll show you another one with the exponential. And then the exponential moving averages of the 50 and the 200. The 50's already crossed above the 200. Here you can see in the simple moving average, the 50, which is the red line, has not crossed above the yellow line, which is the 200 simple moving average. But you can see here I've added a couple of other additional elements to this chart that I just thought were important for you guys to see here. You can see right at this area right here, and as we started to hard hit this and coming back down, this was the area that I told our members we got to pick up some puts. I said the market action is probably going to come back to that level right there and possibly even lower. I would not be surprised to see it come back to this fib node here of 2785, which is 50% of the travel distance that we went from the low to the high when we came off of the 2020 highs and the all-time highs of the S&P at 3393.75 for the S&P futures. Okay. So this is kind of where we're sitting. You can see we got a lot of support underneath. This was the pre-exit or the pre-Brexit vote level. And then right below that's the overnight Trump election lows. So we've got a lot of support down here. But by the way, as I've said numerous times, once we take out this fib node here in a bear market off the bear market lows, then we haven't had in 70 years the markets come down and make new lows. Okay. I mean, the biggest fear in a bear market is any kind of rally is just a bear market rally. I mean, a bull trap until we come out and take out new lows and establish that. But in this particular case, we've never seen that happen if we do an extension of 618 off the lows. I don't believe we're going to do that as well this time. But I do see a target range somewhere around in this area here. It could get really ugly and take us all the way back down to this level here, which would be kind of the resistance point right there. But that would be at its ugliest. I do, as I've said, since that level right there, you can see we could not get above the opening price of or closing price of 2019. In the SPX, the cash index, we were actually in the green for one day, and then that was it. The E-mini futures, we could not do it. And you can see right in that area, that was the signal to just start shorting the market. And clearly we closed below the SMA, the 200 SMA on Friday, and now we got the 50 SMA right below. But I believe we're going to come down. We're going to break that level. You can see we closed at 3003. It's holding up nicely, but I think once that level breaks, it's going to clear the markets to roll down even further. And when we throw into this, think about what's coming up in the month of July. We got Q2 earnings, which are forecast to be the worst, but the good news is they are forecasted to be the worst. So having bad earnings like that is a good thing, because with earnings expectations so low, it's very easy to step over the bar. If expectations were high, I'd be more concerned. So that's kind of given the market a lift, right? It's given a nice lift to it. But I do believe we're going to pull back, and that's kind of what I'm seeing here from this perspective as well. Okay. So these extensions off these lows are going to serve where I see the support area. You can also see I've got volume over price off on the left-hand side of the screen, and you can see there's a lot of volume sitting right here at the 50% level. Okay, there is a little bit of a volume sitting here at that node. You can see how it kind of comes out, and then there's an empty space, and there's not a lot of volume right here. Sitting at that level. So that tells me that we want to come down to this level. Now, we may have a little bit of a gasp up again and then a roll back down, a test, break the 3,000, come up and test, and then give it all up. Remember, we're in this channel right now, okay? And we're in the top part of the channel, but pretty soon we're going to come down to the lower part of the channel, and it's going to happen fast if we break these key levels, and that's where the charts are telling me right now. So for our members, I was having us get short right around June 8th and 9th time frame, and I said the first stop is going to be obvious, which is the moving average, the 200 EMA moving average. On the our SMA rather, I'm sorry. So these are SMAs, as I said. Now, if we look at the volume, and I'm just going to double click on here and put the volume on the screen here. Let me just reduce that down just a little bit. You can see the volume on the screen as we've come down. Volume has picked up a little bit, all right, but it's kind of tapered off. So this big move right here was met by this volume here. Now you'll see I've got two moving averages on volume. I've got a 20 EMA and a 5 EMA. So that represents 1 week over 1 month. So when the purple is below the blue, volume is low. And when the purple is above the blue, volume is high. And typically, even off these lows here, generally volume has just come down dramatically. And then now, as we're coming down into this little channel right here, you can see volume has come down, which is a good thing. We did have a spike on Thursday and Friday right here, but volume overall has been coming down. So keep in mind, we've got an Elliott wave 3, and this is a big impulse move right here. That's typically the biggest move in Elliott wave theory, and this Elliott wave 3 suggests we're going to come down here to an Elliott wave 4, right? And then we're going to kind of stay down here a little bit. Then we're going to make another run back up here again, probably as we go through end of August into September, October timeframe going into the elections. That's the way it kind of looks right now on the chart. But I'm going to be updating this on a daily basis for our members. If you're not a member of our group, I highly encourage you to come in and check us out. We're doing well. We had a great year last year. This year promises also to be good. We're outperforming the market with some of the things that we're doing. So this is kind of how this thing looks right now. If I go take a look at the Ichimoku, let's just put it on an Ichimoku time frame just so that you guys can get an idea. This is the daily chart of the Ichimoku. I got a lot of these yellow dashed lines are pivot points, key pivot points in the market. You can see that we're coming down to a key pivot point around the roughly around the 2966, 2967 area. And it's going to put us in this range right here from roughly 2970 to 2930 in this little area here. And then we have another little range here. You can see the green cloud underneath, which suggests we're going to have some support, but that goes all the way down here to the 2752. Again, this is a daily chart of the Ichimoku. So this is kind of what I'm looking at on these graphs, as we move forward. Now, what I want to do is let's just go over. I want to take a look at volatility for a second. So let me just pull up a vol screen here and just kind of show you how this thing is shaking out. So let me just move my screen over here just a little bit here. Let's see, which screen number is that? That is going to be, oh, I know. Let me just stop the screen here for 1 second. I'm going to move it over like this, and let me get the screen back up for you guys. So let me get the screen up right like this. Here we go. So this screen number 4, it's going to be a clean view of vol. And when it comes up on the screen here, you're going to see here that we're still in the red zone as far as the VIX goes. You can see right here, if we blow up, zoom in on this right here, we're still in the red. We closed out the week for the VIX at 3473. All right, so we're still in the 30s. We got up here about a week or so ago up to 44. I think we're probably going to test that if we, have this pullback that I'm anticipating through the month of July into August. Okay, I'm expecting anywhere from a 5 to a 15% pullback from the current prices, by the way. So that would give us what we're looking for great buying opportunities. So as far as the stocks that you want to pick up, obviously any of the FANG stocks, but let them pull back. There are others that for our members, I'll go through this Sunday evening that you may want to take a look at and pick up on the cheap here. But you can see each of these zones represents a different trading strategy, really, in the options market as well. And you got to understand how vol works to be able to take advantage of it. Okay. Now, if we look at the front month skew with volatility, you can see here we're just barely in the red. So that means we're in a backwardation mode. So there is fear in the market, but not as much as you would think. Okay. The market still believe the Fed put. The Feds are going to come in and just save the market. So any downside is more of an Elliott wave 4 kind of pullback where it's going to be bought. But I do believe it's going to be enough of a pullback. It's going to scare some of the short, smaller players that are, basically long the markets, and they're going to be forced to cover. So that'll probably accelerate some of the downward movement here. And if we look at the back month, which is looking at August and September, you can see here we're also in a backwardation. So we're going all the way out to September. And then you're going to see a spike in October because that is the month, the last futures expiry cycle before the election on November 6th here in the United States, the presidential election. So you're going to see vol kind of be maintained going out that far in time. Okay. I mean, it's just going to be the nature of how this thing works. You can see this big spike also in the vol futures going out in time, where we came all the way up to 2.16, which is a pretty wide disparity in the backwardation and the difference between the August and the September vol futures. Okay. Of course, if we look at treasuries and we look at the bond market, we're still going to be in this range, guys. It's a good right here. It's a good play for iron condors or flies if you understand how to manage them. For our members, I encourage you to go out and check our Option Masters courses again on the bond market. I'm sorry, on the flies and the iron condors. And if for those of you that are non-members, you might want to check it out as well. There's some really interesting things out there for you to learn how to play it. It's not only just putting an iron condor on, anybody can do that, but you got to understand the deltas, the Greeks, and you got to understand how to manage it if you're challenged. Otherwise, you can lose 8 months of revenue in 1 month, in 1 week, if you're not careful. So this is the bond market. Currencies. I'm going to say for our members this tomorrow evening, Sunday evening. If we come down and we look at metals, let's take a look at gold. Gold is trying to break out. You can see we're up to 1796. We're in this shaded zone right here. If we have a pullback like I'm expecting, we're probably going to break out of the 1800. Then we'll come back for a retest, and then we'll take off again. But you can see where the markets are shaping up for gold. Copper. Let me just hold on 1 second here. Let me do something here on my screen. Sorry, guys, just had to adjust a couple of things. So if we look at copper, we've been long copper since late March. And it's been a good go-to trade, all right? It's been a great trade for us. And there are ways to play the metals market and gold. Members, I'll go through that with you also this Sunday evening. And oil, same thing with oil. You can see the zero rate here. And if we look at oil, we're continuing to move up. You can see the MACD as it's rolling down is not a fear kind of thing. It's just more of a consolidation MACD pattern. So we could pull back just a little bit, but I don't see too much of a pullback. And there's certain ways to trade oil. You cannot trade the futures market right now. You can, but I wouldn't do it. And I would not trade the common ETF USO. I wouldn't do that as well. But there's better ways to play oil. Get paid while you play it. And that's a little bit about, and I'm going to review again with our members this Sunday evening how to do that. There's also some plays in nat gas and some interesting ways to play that. I've been talking about that for about a month now. Okay. So these are just kind of where we're sitting. There's a couple of key stocks that we're following as well. Members, I'll go through that with you guys this Sunday evening. There are some that I think may not be a buy right now because, again, I believe we're going to get a little bit of a pullback here going through July into August, anywhere from 5 to 15%. So I know it's a wide range right now, but it's very difficult to gauge these things in this kind of market. So earlier on, I'd said, half empty or a half full. I tend to be a half full kind of guy. Actually, I'm the type of guy that would like, or trader. I don't take either of those options. I think the best option is to say the glass is too small. So, and that's kind of the way we work it. We work it with our red stripe zebra approach. We want to stand out from the herd, and that's what we've been doing since I've been running our group. So everybody, I will see you tomorrow for our weekly market watch. For those of you that are doing just viewing the weekly roundup, Next weekend is going to be a big holiday weekend, Independence weekend, so I may not get our weekly roundup out on the July 4th weekend. So I'll probably see you guys in another week and a half. Otherwise, members, I'll see you tomorrow evening. Have a great weekend, everybody. See you soon. Ciao now.